Hello and welcome. Yesterday, the European currency slipped against the US dollar. Fundamental statistics released in the first half of the previous trading day showed that the ZEW Institute economic sentiment indicators from Germany and the euro area exceeded analyst expectations. However, the market ignored the reports. This means that the euro will most likely continue losing value. Besides, there are growing concerns about a more aggressive approach to interest rate hikes by the US Federal Reserve. Last week, Fed Chair Jerome Powell managed to calm the markets. This week, anxiety is rising again. This in turn leads to a stronger greenback, higher US Treasury yields, and a decline in riskier assets. Today, macroeconomic calendar includes data on December inflation from the UK and Germany. If the indicators are in line with analyst forecasts, there will be no change in market dynamics. If the consumer price index is below expectation, this will put additional pressure on the euro. In this case, bears will most likely make another attempt to hit a new low. In the second half of the day, United States is set to report data on building permits and housing starts. However, these reports will hardly have a severe impact on market sentiment. The focus of traders will be on the Treasury Select Committee hearing as well as Bank of England Governor Andrew Bailey's speech. There are rumors that the Bank of England is going to reduce its balance sheet and raise interest rates further. All these could lead to a bullish reversal in the pound-dollar pair in the British pound's sharp recovery. From a technical point of view, the level of 1310 acts as support for the European currency. A false breakout at this level coupled with an MACD divergence will create a strong buy signal. In this case, the euro will have a chance of recovering to 1.1353. In the event of subdued activity 1.1310, it would be a wise decision to put off short positions until the price reaches 1.1286 or 1.1265. Nevertheless, I still believe that bulls will make every effort to drive the price up and the pair will advance to 1.1353. A full breakout at this mark and a rebound from moving averages will result in a steep drop in the European currency. In such a scenario, I recommend going short. If the price starts moving sideways following false breakout at 1.1353, short positions will be closed. After the price breakthrough and consolidates about 1.1353, traders will be able to consider long position with a view to reaching 1.1391 and 1.1419. At these levels, it will be possible to go short on a rebound, counting on an intraday correction of 15-20 pips. Speaking of the British pound, the situation depends on UK inflation data and Andrew Bailey's speech. If the inflation rate meets analyst forecasts, the pound-dollar pair is unlikely to break about 1.3620 in the first half of the day. The statement of the Bank of England governor will be in the focus of market players. If the indicator is above expectations and the price consolidates above 1.3620, the volume of long position will increase. Accordingly, the pound sterling will rise to 1.3657 and then 1.3693. A false breakout at 1.3620 will create a sell signal, thus leading to a significant decline in the British currency. Otherwise, it will be a wise decision to go long, hoping that the pair's downward correction will come to an end. Long positions at 1.3563 can be considered only in case of a false breakout following pound sterling's drop amid UK inflation data on Bailey's speech comments. Alternatively, a long position can be opened on a rebound at 1.3532 and 1.3496. At the level of 1.3657, I recommend going short only in event of a false breakout. At the 1.3693 mark, short positions can be considered amid a rebound with a view to catching an intraday correction of 20-25 pips. Good luck.